Semil, welcome to the show. Good to have you here.
Inviting
How
me.
are you doing?
Doing great. I'm really excited about this because I've had like 100 friends tell me that they love this podcast.
That's
And
amazing to hear.
yeah,
I'm so glad. I'm so glad that we're breaking through. We've been spamming the timeline, spamming everything on X. We've learned that slop is the future, and volume wins, pace wins, speed kills,
yeah.
and we've been trying to do all of the above.
Also in a previous life, I used to work in the podcast industry and I love the medium. This is way before it really took off.
Yeah,
I love media and I love TV shows, and I always felt like there should be like a live tech VC
yeah.
segment. So I just
Yeah, it's
hats
kind
off
of a
to pulling it
crazy
off.
idea to do a live daily show for technology, but it's been a lot of fun. It's been working out. I'd love to
Did you
start
ever
with.
look at Cheddar back in the
Yeah,
day?
we actually talked to the CEO earlier this
John,
week.
yeah.
I was familiar with it. Where they took that business was much more. I mean, they actually wound up owning ratemyprofessor.com. That was interesting. They also owned TVs on college campuses. And I do think we have a bunch of college students in the audience, but definitely we have focused more on, insider baseball in Silicon Valley and stuff that's not quite as general audience. But who knows where it goes? This is still an early project. It's evolved a few times, and we'll see. Anything's possible.
I love it. Well, thank you again.
Yeah, well, I Great to have you. actually would love to start with your experience in the podcasting industry and what you were doing and kind of what lessons you learned, just because I'm curious. So
Yeah,
maybe we
just
start
real
there.
briefly, it was kind of in the 2012, 13, 14 timeframe.
Hmm.
And the entrepreneur at the time, who was a repeat entrepreneur, who's a technologist and a mentor of mine from Stanford and was on the faculty, had this idea of like a personalized audio. So if
Mm.
I don't want to date myself here, but imagine you 10 years ago or so, you open Pandora on your
Yep.
phone and you're going in the car. What would the AM version
Mm.
of Pandora be? That was kind of the vision. And
Oh, that's
so
cool.
we really spent a lot of time curating the initial set of things that would come onto the platform. The big categories for commute were news, spirituality or philosophy. Comedy was probably the biggest one on the nighttime
Cool. Yeah.
drive. And then it was like giving the person the opportunity to skip. So now, if you're in
Yep.
a Spotify playlist, for example, we just take for granted that we can just skip to the next song, or in Instagram, we can flip to the next reel. But
Yeah.
users didn't really have that amount of control
Yeah.
back then. But ultimately, the cost of acquisition at that
Sure.
time, was really, really difficult.
Mm.
And there wasn't as much podcast content. It was mostly kind of radio or TV content being ported over.
Hmm.
This is pre Joe Rogan and all that kind of stuff. So eventually it was acquired by Apple, primarily for the technology of streaming, the ability to stream from server across different telecom networks.
Mm.
Yeah.
Interesting.
Interesting.
I'd love to know your kind of venture origin story. One fun question is like, what was the
Mm.
deal where you caught the venture bug? What were some of the early deals that stuck out to you as,
Yeah.
hey, maybe I want to turn this into a real career?
Well, it really started because I was working as a consultant for a lot of different firms. I was working in industry and I was writing a lot online and doing lots of media stuff just for fun. And
Yeah.
a lot of people who happen to be investors and LPs read it. And I thought, oh, I was helping a lot of friends raise capital. I thought, of course, one of these funds that is employing me as a consultant will give me a job. That did not work out. And so Haystack was born literally out of desperation of
Mm.
having nothing else to do. And so it started with a $1 million fund. And in the
Wow.
first 8 months, wrote seed checks into Instacart, Envoy, DoorDash, and HashiCorp.
Wow.
Uh,
Banger after banger after banger after banger. We love to hear it.
and
Congratulations.
I knew in the first two funds, which took about 3 years, I knew that I would enjoy it because I had been around it a lot, and so it
Hmm.
was a lot of fun.
Hmm.
I, I did not realize how much I would love it.
Hmm.
Um, and then the other component, I was called luck and love. Like Mike Maples has a great line, which is like, "You got to get hit by the lucky truck,"
Yeah.
And I got hit by the lucky truck a bunch in the
Yeah.
first 3 years. So
That's
it
amazing.
was very fortunate, but it was a different era. Like I could never raise as much as I wanted to for
Hmm.
funds, and I would have to beg, borrow, and steal to make sort of ends meet at home. You know,
Yeah.
so
Yeah.
for a
Do
long
you
time.
Yeah, I imagine
when
you're
you
not
see
eating foie gras on the $1 million fee
management fees?
structure
Yeah, it's 200K over 10
over
years.
10 years. Yeah,
Pretty
Yeah, yeah.
brutal.
I
Do
didn't
you?
take any fees really in the first three funds.
I'm sure. Yeah,
And yeah.
that's great.
Are you surprised today when you see managers without much of a track? I mean, you listed off a few of the companies that you invested in the first fund.
Yeah.
You would think that that kind of portfolio would get you a, if you had that today, it would probably get you a $500 million, fund two type of thing. Are you, when you talk to, upcoming managers today and they're sort of complaining about sort of the challenges of raising money, yet they're still raising, $50+ million funds.
Yeah.
I'm assuming you don't have a ton of, I mean, you have empathy, but you're also,
Yeah. Well, it's a very astute question you're asking, especially since we don't really know each other, because that is a very astute question for two reasons. One is that the rational answer to your question is that it kind of makes sense because, back when I started, people didn't really know how big Uber could be or Palantir could be. It was like, well, I'll just wait to see what happens. I mean, a lot of VCs just passed on Palantir for rounds and rounds and rounds and rounds.
Oh, yeah.
And Uber was like, just kind of blew people's mind of how fast it grew. So now I think a lot of LPs and a lot of people around the world are like, hey, the tech startup ecosystem is a place where I need to have some money at play because, people who come on your show, like, I mean, Kari, I have a great story about Kari, by the way, so we got to jam that in.
yeah,
But
let's do that.
yeah, people like Kari are like coming here from, Europe and like doing amazing things. And like you find one Kari in a career, or in a portfolio, it's amazing. So I kind of understand that more LP dollars are coming here. America is a more attractive, the American entrepreneurial ecosystem is an attractive place to park some money and put it in the ground. It totally makes sense. And when your choices are $1 billion plus funds charging you 30% carry, and they're going in a little bit later, it's kind of like, well, okay, do I, which burning building do I want to fall off of? Now, the more micro answer and why I thought that was an astute question is that a lot of people come to me and ask for advice or help with LP intros or how to like
Sure.
design their fund or do stuff. And I've learned, from like, I had amazing access to people and that cannot be shortchanged. Like I was very lucky to have access to like incredible VC people, VC creators and fund creators that you would all know by name. I had direct access to them and still do. So I try to pay it forward by helping with LP intros and doing all that stuff. But occasionally I do get that, oh my God, like, I need to raise a fund of this size to pay myself. And I always come back with, who says you need who owes you a salary to deploy the money? Yeah. And that's really the line I always come back to, which is it's a little bit unfair because you could have a really qualified person who doesn't have access to capital. And part of the game of a VC is to aggregate capital for the entrepreneur. That's part of the game.
Yeah.
So if you have a unfair capital relationship or an asymmetric relationship where you can aggregate capital, all of a sudden you're in the game, but then you have to access the founders. So it's that you got to aggregate supply on both sides, high quality supply on both sides. But this idea that like the fund should start paying you is a luxury in my mind. And of course, if you have access
But
to capital,
isn't
people are willing to pay the fees, like you can get paid.
Yeah, isn't today though? I feel like from my understanding, if you go to LPs and you're trying to raise a small fund, let's say 10, 20 million bucks, and you say, I'm not going to have any fees or maybe a very small admin fee to cover the costs. Isn't that, given that they're just so used to paying fees everywhere, is that even like a selling point, or does that send the wrong message to?
That's a fair question. I think that LPs are happy to have their GPs, if they want to work with them, pay them in some fees. I think the point is that when you're starting and you're trying to hit a target or you're spending a year or two trying to fundraise, the idea that like you're owed a salary philosophically to me is kind of bankrupt. And that like you can say you're going to do that, but at the same time, it is a market and LPs vote with their feet, and sometimes they make smart decisions and sometimes they don't.
Yeah.
But yeah, I would say that somebody going into market with that $30 million fund should have a budget for how they want to pay themselves, but also like um, sometimes you have to cut deals when you start. Like, you know, a lot of people who want to raise an $100 million fund, maybe the market only gives them 6 or 8, you know, and it's like, that's where you should start. But a lot of people don't want to start there.
Yeah.
And it's a little bit unfortunate because AngelList, which kind of came up when I was coming up, created a whole new pathway for me too. Like that's available to you now, you know? And so a lot of people do use it, but I think a lot of people want to aggregate more and more capital before the market's ready for it.
What
Yeah.
AngelList products were you leveraging most aggressively on the come up?
Oh
We've
yeah,
heard a lot of
this
these
could be its
different.
own. This could be its own pod, deep dive pod.
Break it down.
I mean, I went. I mean, first of all, genius.
Yeah.
You know, and really was helpful to me. But essentially, there were a couple of like public products and a couple of off book products. The public products were that you could do these kind of like software click and subscribe SPVs.
Yep.
You know, where if you could aggregate from your following or people who were following you and say, okay, I have overcapacity in a deal, you know, I've got a 50K allocation in a Series A that I did a seed in, and I don't even have the money, right?
Sure.
You could do that and then set the carry. You could even do little things like portion out the carry based on, you know, people who are helping you on the deal or other people you want to give a little gravy to. Then it turned into like these rolling funds or AngelList funds, which are very popular, you know, 18, 19, 20, 21, and are kind of industry standard today. And then the, I hope Naval doesn't mind, but like the off book thing, he did me a solid for because I had known him for a long time and he is just incredibly helpful and savvy. But he had raised a private pool of capital in an SMA from I can't really disclose who, but let's just say a large sovereign that wanted to basically pump a lot of money into the ecosystem, and he picked 4, you know, early managers to kind of whitelist, and he chose me and told them just do whatever he does.
That's great.
When you're, I'm curious, how long should someone wait to get hit by the lucky bus before they should, you know, hang up the cleats? Because I really do feel like in my personal experience, if you're in venture seriously and you don't get a true banger in the first 5 years, like your job just becomes infinitely more difficult in every conversation you have, from LPs to entrepreneurs to other managers that you might be co-investing with. But I'm curious how if you've seen examples where, like, you know, year 8 they finally get the banger.
This is a very, very good question. I mean, I should be back on this pod at some point because you guys are asking like the right awesome detailed questions. It kind of depends, I think, to answer your question based on what fund you're at and what stage you're investing in. So let's say you're at a larger fund and you're doing kind of like a classic Series A where you're joining a board or you're putting 7-8 million plus in a deal. Maybe you're doing Bs at 2025. You can only do in a high quality sense maybe 2 to 4 of those per year. And everyone that's your partner or who's around you or the bigger heads in the fund, they'll ask you to report on your portfolio on a monthly, quarterly basis, and they'll have a sense of an underlying, like what's happening there, sort of like a few times a year. They're now, obviously the boards are going to be using AI, the funds are going to be using AI to like track the board. So it's not just about the relationship with that investor, but like sometimes the investor in the old days could say everything's going fine, but underneath the hood, it's on fire. They'll have more of a record of what's happening. And so generally the people who are running the funds will watch and see like what are the underlying metrics, who's going to follow your deals, right, as a proxy for quality. And so all those things are under a microscope. I think when you're a seed investor like myself, where you're in that early part of the ecosystem where you're not investing $7 million per deal, but it might be 200K, 500K, $1 million, you can take a lot more shots on goal. And people suspect that some of those things are not going to work, and you only need a couple to work, right? So you have more surface area to get hit by the lucky truck early. The trade-off is that you don't own as much as you would if you did a rifle shot later. But yes, I think 5 years is actually too long.
Yeah.
And there's a couple heuristics here. Like it used to be in venture when you would join like a really good fund, they would hand you a later stage deal that already had a board in place and already had some momentum underneath it, so you could learn the ropes and have like a good kind of chip to put on the mantle to start. But if you think back, I don't know if you have come across Matt Kohler, but Matt Kohler was a GP at Benchmark for 12 years. And this guy's hit rate at Series A was incredible. And even he doesn't even get credit for certain deals that he sourced, but he just doesn't care, you know. But very few people are going to have that rifle shot selection that Matt did. Someone today who I would mention would be like Mamoon at KP. I mean, you look at the guy's track record; it's absolutely insane to pick off the money round.
How common is it for you? Because I'm assuming you're LP in a ton of different funds at this point. How often do you see like a $50 million fund these days that's fully deployed in a lot of winners, but just not, kind of a dud of a fund just because of concentration issues, pricing, et cetera?
Well, I do lots of small investments and friends and like other people to support them when they're starting funds. So it's relatively small. The funds are relatively small. And when the funds are a little bit bigger, those managers have already had experience around portfolio construction.
Yeah.
So you can get away with kind of shittier portfolio construction when it's a smaller fund because you're just really chasing the alpha in that. But I would say the broader point I would make here is that the idea of portfolio construction and the math around it, it's no more complicated than basic algebra. And I would say I probably spent a lot of time trying to learn it and around a lot of other investors to deeply understand it. And it was still probably the hardest topic for me to like grok or years for me to grok. And I think that's why a lot of LPs like to fund people who come out of these bigger funds, because you're served that every week when people are doing partner meetings and portfolio reviews, and the people running these funds know it. So it's very hard to learn from scratch.
Totally.
I want to follow up on a talk we had with Sam Lesson yesterday. He was saying that the unicorn factory is broken, and it sounded a little bit like he was complaining that just like the big funds, the crossovers have squeezed the growth investors. The growth investors mess up all the early stage markets because they're just like, $10 million Series A doesn't really matter. And then the Series A investors mess up the seed markets, and the seed markets mess up the angel investors. How real is that dynamic? Are you feeling pressure? Are you optimistic? What's your takeaway on the broken unicorn factory?
I got to watch the Sam episode. That guy's full of amazing thoughts.
He's a hot takesman.
He is a hot takesman. Very artful. I think Sam's exactly right. Everyone is on everyone else's lawn. And so it's definitely a concern. I still feel at the end of the day, and maybe this sounds like Pollyanna, but like the game is, can you meet great entrepreneurs every week, every month, and you're not bogged down by other BS that your partners throw on you, or that you go to stupid conferences. Like we all have like a ton of time every week. And we should all be meeting awesome founders as much as we can. And like, can you connect with them? Can you get to know them? Can you take a bet on them? And I still think you can, because a lot of investors have ADHD and they go to stupid conferences and they go to stupid meetings. And so that's my kind of view, is that like, you're not going to catch everybody. There's no way to meet everybody, but like there's plenty of people here that you can take a bet on. And you can get paid, if you're only chasing hot deals and everything's priced to perfection, we all know where that goes. So the other thing I will say is I've been seed investing, in this part of the market for 12 years now. And every single year, with the exception of like a few 6-month periods of like COVID or dislocation or something, every year people complain there's too many smart people starting companies, there's too much money in the early stage market, and the round sizes and the valuations are too high. I hear that every single year. So I just don't know when that's going to stop. Like maybe a meteor will hit the Earth. I don't know.
No,
You know?
I got to Silicon Valley in
No,
2012, and I got a big sit down speech. We are in a bubble, and it was like, yeah, we were for another decade.
Yeah, I mean, one of the things that makes me so bullish on America is just we spend every single day talking to bright entrepreneurs, and at a macro level, it's obvious that there's bubbles in different, kind of sectors and industries, right?
Yep.
People say, oh, manufacturing isn't investable. And then you talk to an entrepreneur who's like,
Actually
spent
cracking
6
it.
years
Yep.
developing like a proprietary method for manufacturing metal, and you're like, yeah, you're gonna sell
This is
billions
gonna
of
work.
dollars
Yep.
of this product. I want to ask you about two archetypes of new fund managers, and I want to get maybe the advice that you kind of like give them as they think about raising. So the first one is the angel investor who's sort of casually lucked into maybe investing in a bunch of winners while they weren't taking investing seriously. And I think this is fairly common. Somebody's like working at a great company, or they're a founder and they just happen to invest in, let's say they invest in 15 companies, a couple of them end up being unicorns, and they decide they want to become a fund manager. And then the second archetype is somebody who's at a big fund, gets hit by the lucky bus maybe, but doesn't really realize the kind of dynamic in which enabled that investment, which might have been the fund's brand, or it might have just, a variety of factors. So I'm curious how you talk to those types of managers, both of which believe that they deserve a $50 million seed fund and deserve they should be, able to kind of like win deals, and they very possibly can, but it's not necessarily a walk in the park.
For the angel archetype, I mean, let's not forget, like Elad Gil was like a super angel and then turned into like his own growth fund as a brand. I mean, it still amazes me to see like the entrepreneurs, when they create their Coachella banners for their huge fundraisers,
It's just
and they'll
Elad
put
Gil.
Andreessen Horowitz, Elad Gil. I'm like,
Elad Gil.
okay, that's pretty awesome.
It's awesome.
So, he was born from that. I think that like the pattern, going back to your question, is hey, you've been doing this as a founder or stuff. I would think about a couple things. One is like, when you have a founder, especially a founder who's like, or operator who's like very, very connected and just kind of angel investing for fun, a sophisticated LP. Now the problem is here, to do a $20 or $50 million fund, that person could just call his or her friends, But let's say if you're going to like a sophisticated family office or institutional investor or fund of funds, and all these emerging manager programs are popping up. That LP knows that they're trading off access that this person may have that's unique for that portfolio construction and discipline of building the basket. And so that person, I would advise to say like two things to watch out for is, how are you going to get smart on the portfolio construction and build a model that works and kind of stick to it. You can deviate from it a little bit, but you want to show consistency, right? Because as you build up your track record, literally when we raise funds, we may or may not be in the middle of that right now. They take your whole bank ledger, like every dollar that comes in from an LP and every dollar that's wired to a company is just in an Excel spreadsheet.
Yeah.
And so everything is recorded.
Mm-hmm.
And so, you go too wild by a second or third fund when an LP is really looking at you, they may say like, love to see this smoothed out a little bit,
Mm-hmm.
The other thing is just what I say, network atrophy, which happens to everybody, which is like, if you're not constantly replenishing your networks, not everybody are the Collison brothers.
I mean, the big red flag for me on the angel side is, as an angel, I have 50 plus companies that I've put various checks in. Both of my, true banger unicorns, I got 25K into. If I tried to do 50K, they would have said, sorry, like, we have a bunch of people in the round.
You had
and
access,
so
but not that much access.
Yeah, I had access, and I was intelligent enough to just give the founder money. But so if I were to go out and raise a fund, it wouldn't be authentic to say like, oh yeah,
I
if
could
I
totally
had a
put
seed
$1
fund
million
at that
in.
point,
I totally
I
could have
would
done
have,
it.
you know,
Yeah.
been co-leading the round or whatever. It's just not.
You're talking about like what happens with check size escalation. So like I'll give you a couple of things to noodle on. So for me, I had no choice but to crawl, walk, run. So I was incrementally increasing my check sizes in the same kind of rounds. So the same rounds I was doing 12 years ago, we're doing today. Now, most people will just say, oh, I can go a little bit more. I tend to think if you talk to other seed investors, that kind of line is around somewhere between when you're asking for 250 to 500K starts to get tight.
Yeah.
So you could have one model is you could have an aggressive angel who gets that right away and starts firing the $1 million instead of 25, and they still have a hot hand, they still have a good network, they still have good judgment and knows, like that can work. The problem is like you're probably gonna light a lot of money on fire too because the deals are moving too fast and they don't have like that deal judgment going. But the broader point you're making is a very good one, which is around like what check size can you really write in the competition set?
Yeah. In the companies that matter.
This is fantastic. We definitely do have to have you back on. We could talk for another 5 hours.
I got to ask one more question.
Please.
How do you think X is today in comparison to the good old days of Twitter? I think you were one of the first people I ever followed on tech Twitter.
Same here.
I got on like somewhat late. I was in college, but
I mean, 5-letter username. It's no 4-letter username like
it's
at
really
TBPN, but it's pretty good.
Like, I'll see new people follow me, and like usually it's just bots or people with like an animated.
The anime profile pictures, there's alpha in those. Some of those folks are really great AI engineers.
But like recently, a bunch of people have like followed me, and I'll look at like recent followers, and it'll be like Barack Obama.
Wow, that's awesome.
What's so funny? If Elon, if you're listening, I love X. I love Twitter. I've been on it for, I don't know, over 15 years. I just want TweetDeck back. Because I think TweetDeck being removed has disrupted my flow, and I haven't been able to like find my footing again. But I think the content on there is great. It's harder to find. Right now, and I tend to get the best tweets in my social chats, in my group chats.
Yeah.
And to me, that's a sign that like the interface is too much.
Yeah, we talked about this with Eric Torenberg a little bit. A lot of the alpha has shifted to these big group chats, and there is a little bit of that that's lost. I mean, Twitter originally was like the global group chat for the world and for tech, and you had NFL Twitter and all the different Twitters. There's still a little bit of that, and we're bringing it back with this show.
I think Elon and them can make more money by going back to TweetDeck, redesigning it, and then in each stream you can have different ads just at the top. It's like such low-hanging fruit.
Yeah.
Yep.
Well, this was awesome. Thank you for coming on. Let's do it again soon.
Congrats to you guys. Yeah.
Thank you.
Great to meet
talk
you.
to you
You're the man.
Take care.
Cheers.